Welcome, everyone. You're on the Smart Capital School of Financial Literacy channel.
Glad to be here.
We're just so glad to have you here with us today because, let's be honest, you have probably been looking at your portfolio dashboards lately,
Oh, absolutely.
just watching the tickers flash red and green in these really wild swings and just wondering what on earth is happening beneath the surface.
That's been a lot to process.
It really has. We are currently staring down what can only be described as a perfect storm in the macroeconomic landscape here in early March 2026.
A perfect storm is the right phrase for it.
Yeah, and if it feels like the broader market is acting completely erratic right now, you are not imagining things. We have these massive, highly contrasting forces pulling global equities and commodities in completely opposite directions.
Right.
And it's resulting in some serious day in and day out volatility that is, frankly, shaking out a lot of retail investors.
That is the crux of the current environment, really. The whiplash out there is palpable, and the divergence we are seeing beneath the index level is historic.
Completely historic.
And that brings us directly to our mission for this deep dive. Our goal today is to help you cut through that daily headline-driven noise.
Because there is a lot of it.
So much noise.
Yeah.
We are going to unpack the specific heavy-hitting macroeconomic data that just dropped over this past week. And we want to give you a clear, objective map of what is actually driving this market volatility.
You want to map it out.
Exactly. The objective is for you to understand the underlying mechanics of capital flows right now without feeling sort of overwhelmed by the sheer volume of financial news.
Right.
Because in a market this complex, understanding the why behind the price action is your best defense against uncertainty.
Okay, let's unpack this. And I want to start with what I think is the most staggering piece of data we've seen, which is this great ETF rotation.
It's massive.
It really is. We are witnessing a massive, undeniable shift in capital allocation between what worked brilliantly in 2025 and what is happening right now at the start of 2026.
A total reversal.
Yeah. The numbers alone tell an incredible story of shifting sentiment. Let's look at the growth sector first.
Let's do it.
VGT, Vanguard's Information Technology ETF. I mean, this was an absolute juggernaut. It was up almost 22% in 2025.
Unstoppable momentum.
You look at that momentum and think, yeah, it's unstoppable. But so far this year to date in 2026, it is only up 3.88%.
It is a profound deceleration, to say the least.
Profound is the word.
And it indicates a fundamental repricing of risk. Institutional money is moving.
It really is an abrupt halt. And it's not just VGT. Look at QQQ.
The NASDAQ 100 tracker.
Exactly. In 2025, it posted an almost 21% gain. But currently, it is sitting at negative 1.75% year to date. Bleeding out. Even the broader blended market is feeling this immense drag. VOO, tracking the S&P 500, was up nearly 18% in 2025.
Right.
But it's barely treading water right now, up only 1.46% year to date.
Which is basically flat when you factor in inflation.
Exactly flat. But here is the absolute outlier.
Safe haven.
Right, SCHD, the Schwab U.S. Dividend Equity ETF, which is fundamentally a value and dividend play. It is completely decoupling from the broader indices.
It's doing its own thing.
Totally its own thing. While growth is stalling or bleeding out, SCHD is currently up 12% year to date. It's absorbing these recent market shocks like they are nothing.
To understand this, we have to look at the concept of equity duration.
Walk us through that.
Why is this rotation happening so aggressively?
Well, for the last few years, investors were essentially buying long-duration equities.
Growth stocks.
Right, growth stocks, where the bulk of the company's expected cash flows are years or even decades in the future.
Right.
When borrowing costs were perceived as manageable or dropping, investors happily paid a premium for that future growth.
They were paying for 2030 today.
Exactly. But now we are seeing a massive psychological and strategic pivot. Institutional money is looking at the current macroeconomic climate, and they are moving away from those future growth promises.
They're sprinting away, sprinting toward short-duration assets. They want companies generating massive free cash flow right now, today.
So it's essentially a flight to quality, but specifically a flight to present-day yield.
Yeah.
Cash in hand versus some projection model for 2030.
Precisely. And when you look under the hood at SCHD's specific screening methodology, it perfectly illustrates what institutional capital is hungry for right now.
Because it's not just any dividend fund?
Now, SCHD doesn't just blindly aggregate high-yield dividend companies. Those can often just be value traps.
Right, a high yield because the stock price crashed?
Exactly. You don't want that. So SCHD strictly screens for companies that have robust free cash flow to debt ratios.
Okay.
It looks for a high return on equity. It demands a minimum of 10 consecutive years of dividend growth, and it requires highly sustainable balance sheets.
Bulletproof company.
In times of geopolitical tension and sticky inflation, that specific profile is bulletproof to investors.
Makes sense.
They want companies that can self-fund their operations and return capital to shareholders today without needing to tap into debt markets where rates remain so volatile.
So they don't have to borrow at these high interest rates.
Exactly. That is the mechanical reason value-style companies are thriving while tech multiples contract.
So mapping this out for you, the listener, the playbook has fundamentally shifted.
It has.
The market has rotated from long-duration future promises to short-duration present-day safety. And that rotation isn't happening in a vacuum.
No, it's being pushed.
It is largely being driven by three major macro catalysts that are causing all this underlying volatility. And actually, before we break down driver number one, I want to turn to the audience. Thank you for joining us. Let us know in the comments how you like this format of video analysis and what topics you'd like us to cover in future videos.
We always monitor that feedback to tailor our research.
Oh, absolutely do.
Let's dig into those three major drivers because they are deeply interconnected.
All right, driver number one, geopolitics in the energy sector. We have to address the conflict in the Middle East.
It's the elephant in the room.
It is. And looking at this strictly from an impartial, factual standpoint, we have seen a major escalation involving U.S. and Israeli strikes on Iran, followed by Iranian retaliation.
Right.
This is an incredibly complex, serious situation globally. And strictly through the lens of capital markets, it is sending absolute shockwaves through energy commodities.
The through line from that geopolitical escalation to the broader stock market runs directly through the price of crude.
Yeah, oil.
This recent escalation pushed oil above $80 per barrel. That marks the highest level we have seen since 2024.
Which is a huge psychological barrier.
It is. And when oil surges that violently, it creates an immediate cascading margin compression across the entire economy.
Now, obviously, higher fuel prices hurt transport, but the market reaction seems disproportionately severe.
How so?
Well, we saw airline and travel stocks plummet almost instantly, and it dragged the Dow down 1,000 points in a single trading session. 1,000 points.
It was a brutal session. To take that a step further, it's not just that airlines have to pay more at the pump. It's about the breakdown of corporate financial buffers.
The hedges.
Exactly. Major airlines and logistics companies use sophisticated fuel hedging contracts to lock in prices and protect their profit margins.
Right.
But when oil spikes this rapidly due to a sudden geopolitical shock, those hedges often prove inadequate, or they expire, forcing companies to buy at spot prices.
And spot prices are brutal right now.
They are. Institutional investors know this, which is why algorithms instantly reprice those stocks downward. The profit margins are mathematically compressed overnight.
Yeah, the math just changes instantly.
And the larger systemic threat the bond market is eyeing right now is the psychological and economic barrier of $100 a barrel.
The triple digits.
If Brent crude breaches $100, we start seeing real demand destruction.
Meaning people just stop buying things.
Consumers stop spending on discretionary goods because it costs too much to fill their gas tanks. Furthermore, that energy cost bleeds into the production and transportation of every physical good, which directly drives up headline inflation.
Which perfectly sets up the complexity of driver number two, the tariff tug-of-war.
Oh, this is a fascinating one.
It really is. The current trade policy landscape is incredibly fractured right now.
Very messy.
Presenting this impartially, we have a massive, unprecedented legal and political battle unfolding that is completely muddying corporate forward guidance.
Nobody knows what to expect.
Exactly. The courts recently ruled that specific parts of the administration's tariff program were actually unlawful.
Right.
And because of this ruling, the federal government might be legally forced to refund over $130 billion in collected tariffs back to these corporations.
That $130 billion is the crux of the uncertainty. That is a staggering liquidity injection just hanging in the balance.
Right. If I'm a massive importer, getting a sudden billion-dollar refund check is incredible news for my balance sheet.
It's a massive windfall.
But simultaneously, the administration has proposed a brand new 15% global tariff on imports.
Right.
And in response to that proposal, roughly 20 individual states are currently suing to block it in federal court. It is a complete legislative and judicial tug of war.
This creates a fascinating macroeconomic paradox.
How so?
Well, on one hand, you have the Federal Reserve trying to cool down the economy to fight inflation.
Right, higher rates to slow things down.
But if the courts force the government to suddenly inject $130 billion of refunded cash back into corporate coffers, those companies are going to deploy that capital.
They aren't just going to sit on it.
Exactly. They will buy back stock, pay special dividends, or reinvest in infrastructure. That is a massive, unexpected liquidity shock that essentially counteracts the Fed's tightening cycle. It's almost accidental quantitative easing.
Wow, accidental quantitative easing. That completely undermines what the central bank is trying to achieve.
Exactly. And on the flip side, you have the threat of a new 15% global tariff.
The new proposal.
If implemented, companies have to completely reorganize their global supply chains, which costs billions. And ultimately, those costs get passed to the consumer, further driving up inflation.
So no matter what happens, it's a huge disruption.
This is why the market is exhibiting such volatility. Markets can efficiently price in bad news, like a known tax hike, and they certainly price in good news. What institutional capital absolutely despises is an unquantifiable binary outcome.
They hate uncertainty more than bad news.
They do. This legal limbo makes accurate corporate earnings projections nearly impossible, and that lack of visibility translates directly into wild intraday market swings.
Okay, let's move to driver number 3, which brings us to the domestic economy and the most immediate piece of hard data we have.
The labor market.
The cooling labor market. We just got the new jobs report yesterday for February 2026, and the data is flashing some serious warning signs.
It definitely is.
Non-farm payrolls actually contracted, falling by 92,000 jobs.
A negative print.
Additionally, the unemployment rate ticked up to 4.4%. Hiring momentum is undeniably stalling, and this marks the third time in just 5 months that the U.S. economy has printed negative job growth.
Right.
The trend line is objectively deteriorating.
It is a fundamentally weak print. Job creation didn't just miss estimates, it inverted.
It went backwards?
But what is highly counterintuitive here is how institutional equities actually digest this specific type of bad news.
This is where it gets weird.
Very weird. On Main Street, losing 92,000 jobs and hitting 4.4% unemployment is a recessionary indicator. It guarantees short-term volatility, which triggered the sell-off we saw on Friday. However, Wall Street views this through the lens of monetary policy.
But wait, I have to push back here.
Go for it.
I know the classic bad news is good news Wall Street narrative. The idea that a weak economy forces the Fed to cut interest rates, which boosts stocks.
Right, that's the playbook.
But isn't there a massive risk right now that the Fed just can't cut rates? If oil is shooting past $80 and tariffs might re-accelerate inflation, doesn't a shrinking labor market just mean we are heading straight into stagflation?
Low growth, high inflation.
Exactly. Low growth, high inflation. That's the real nightmare scenario, isn't it?
That is an excellent pushback, and it highlights the exact tightrope the Federal Reserve is walking right now. You are describing the stagflation risk, which is the worst-case scenario for both equities and bonds.
Right.
However, the prevailing market thesis, the reason some capital is actually cheering for this weak labor data, relies on the mechanics of the Phillips curve.
Okay, break that down for us.
The Fed closely monitors the labor market because wages are the stickiest component of inflation.
Right. Once people get a raise, they don't give it back.
Exactly. If hiring freezes and unemployment rises, the bargaining power of labor drops. Wage pressure rapidly declines because companies aren't forced to offer massive premiums to attract talent.
So the disinflation from falling wages effectively cancels out the inflation from rising oil.
That is the hope the market is pricing in. If wage growth collapses, core inflation cools down substantially. And if core inflation cools, it gives the Federal Reserve the undeniable data they need to finally confidently cut the federal funds rate.
They finally get their excuse.
They do. They've been holding rates higher for longer because they were terrified of reigniting demand. But a genuinely softening labor market provides the exact fundamental justification required to accelerate their timeline and slash borrowing costs earlier in 2026.
Wow.
And as we discussed with equity duration earlier, lower interest rates broadly expand the valuation multiples of stocks. But paradoxically, this painful labor data could act as the catalyst that lowers the discount rate and triggers the next massive leg up in equities.
It is such a complex mechanism to wrap your head around, but when you map out the capital flows, it dictates everything.
It really does. It's all connected.
Which brings us to the most actionable part of our deep dive today. As an investor, knowledge is your leverage, and you need to know exactly what is coming down the pipeline.
You can't fly blind right now.
No, you can't. You need to mark your calendars because the remainder of March 2026 is stacked with economic data releases that will act as the final arbiters for these market drivers. Let's build out the March roadmap.
A roadmap is vital because the data dropping this month will confirm or deny the stagflation thesis you just brought up.
First major stop, March 11th. We have the CPI inflation report, the consumer price index.
This print is going to be heavily scrutinized, particularly the divergence between headline and core CPI.
Because of the oil.
Right. Because of the geopolitical oil spike we discussed, headline CPI, which includes food and energy, is almost guaranteed to run hot.
It's unavoidable.
But the market and the Fed will be hyper-focused on core CPI, particularly the shelter and services components. If core CPI shows meaningful deceleration despite the oil shock, it supports the rate cut narrative.
Which the market wants.
Right. If core inflation is sticky, expect a severe market sell-off as rate cuts get priced out of the calendar.
Okay, next critical dates. March 17th and 18th. This is the two-day FOMC meeting culminating in the Fed's interest rate decision and, crucially, their updated economic projections and dot plot.
Think of the Fed right now like someone driving a heavy truck on an icy road.
That's a good analogy.
If they slam on the brakes, meaning they hold rates too high for too long to fight the oil shock, they risk losing control and sliding the economy into a deep recession, especially given those negative payroll numbers.
Right.
But if they hit the gas-cutting rates too aggressively to save the labor market, they risk spinning out and letting inflation run rampant again.
They have zero room for error.
None. They are going to have to make incredibly nuanced adjustments. The tone of the Fed chairman's press conference on the 18th will dictate bond yields for the next quarter.
Also, on March 18th, right in the middle of that, we get the PPI report, the producer price index.
Yes.
This is essential because it measures wholesale and business level inflation, acting as a leading indicator for what consumers will eventually pay down the road.
It's the pipeline inflation.
Exactly. But then we hit March 20th. This is a date a lot of institutional money is circling, and it brings us full circle to the beginning of our deep dive. This is the annual reconstitution date for SCHD.
A huge day for flows.
Right. I know ETF rebalancing sounds like an obscure technical event, but the market mechanics here are massive. The fund administrators are going to execute a strict rules-based shift, adding in new companies that meet their stringent free cash flow criteria and ruthlessly liquidating the underperformers.
The scale of this event cannot be overstated. When a fund the size of SCHD reconstitutes, it forces billions of dollars of automated passive buying and selling in the underlying stocks.
Billions.
To give you context, during the 2025 reconstitution, the rebalance significantly concentrated their exposure into the energy sector, while simultaneously slashing their holdings in regional financials and consumer discretionary stocks.
That was a huge shift.
It was. Roughly 20% of the entire portfolio's holdings were turned over.
20% turnover for a fund managing tens of billions in assets creates a massive liquidity event.
It creates immense underlying volume. Now, anticipating this upcoming March 20th shift, the fund is going to mathematically recalibrate based on the realities of 2026.
So what are we expecting?
Well, given the high oil prices, the tariff uncertainty, and the premium on immediate cash flow, we will likely see them overweight highly defensive, resilient sectors. Companies that have fortified their balance sheets over the last 12 months will see a surge of passive inflows from this reconstitution.
Which just feeds the momentum.
Exactly, likely driving the ETF's outperformance even further against the broader S&P.
And finally, rounding out the month, at the end of March, we get the JOLTS report. And now, just to anchor this for everyone, we aren't just looking at the gross number of job openings here.
No, you have to look deeper.
We're looking specifically at the ratio of job openings to unemployed workers. This is going to be the crucial data point to see if that weak labor trend from the February payrolls is accelerating or if the economy is finding a plateau.
It's the true measure of labor tightness.
So let's bring this all together. What does this mean for your portfolio? We've covered significant macroeconomic ground today.
We really have.
It is truly a perfect storm. We have institutional capital aggressively rotating into dividend ETFs, crude oil spiking on Middle East conflict, a $130 billion tariff lawsuit injecting uncertainty, and a labor market that is finally cracking under the weight of high interest rates.
It's a lot to navigate.
It can absolutely feel intimidating to watch your ticker symbols bounce around in this environment. But when you understand these mechanics, when you understand why airline hedges are failing or why bad jobs data might actually rescue equity valuations, you stop reacting to the red days with panic.
Exactly.
And you start managing your capital with purpose.
That is exactly the mindset shift required. And speaking of managing capital with purpose, the most practical, actionable takeaway for you today comes down to asset location, not just asset allocation.
Oh, that's an important distinction. Let's get into that.
Because of this massive institutional rotation into dividend-paying assets like SCHD, you need to be highly strategic about which accounts hold these specific assets.
Because of the taxes.
Exactly. You have to carefully calculate the tax drag of holding high-yield funds in your standard taxable brokerage accounts versus sheltering them in your tax-advantaged retirement accounts like an IRA.
Right.
Ordinary dividends are taxed as income. And as you defensively position your portfolio to weather this 2026 storm, optimizing your account structure to shield that yield could save you a significant amount of capital over the fiscal year.
Such a critical point. All the macroeconomic analysis in the world won't help if you let inefficient tax structuring eat up the yield you just strategically rotated into.
Precisely. You have to be smart about where you hold these assets.
Absolutely.
And to leave you with a final provocative thought today, something to really analyze as you watch the price action unfold this week, I want to bring it back to that strange paradoxical dynamic between Main Street labor and Wall Street equities. We discussed the Phillips curve and how a weakening labor market, actual job losses, and rising unemployment might be the exact necessary catalyst the Federal Reserve needs to confidently slash rates and expand stock multiples.
Right.
So the paradox to mull over as you watch the ticker tape is this: just how much underlying economic pain, how many lost jobs and closed businesses is the stock market actually rooting for right now before it feels structurally safe enough to ignite the next bull run?
Wow. That is a heavy, deeply fascinating question.
It's the reality of the market right now.
Just how much Main Street pain is Wall Street actively cheering for? We will let you chew on that one as you navigate your trades this week. Thank you for watching this video to the end. Subscribe to the channel, like it, and see you in the next retelling.